I'm Sean Aylmer, and this is a Fear and Greed extended interview. All the other good bits we couldn't fit into the daily podcast. If you're looking for the daily episode of Fear and Greed, check the podcast playlist. Otherwise, enjoy the interview. There's been some high-profile listings this year, none more so than Airtasker, which last week hit the bourse, jumped 170%, only to tumble again. In that case, it seemed that social media was ramping the stock. What it highlighted was that volatility in stocks can be extreme, and that really isn't a good thing. To talk us through the market and volatility, particularly among smaller stocks, I welcome back to Fear and Greed Matthew Kidman, Principal of Centennial Asset Management. Matthew, welcome back.
Hi, Sean. How are you?
Well, thank you. It seems to be a year full of IPOs. Is that right, or is that just an incorrect perception?
Well, it kicked off towards the end of last year. There was a mad scramble leading into the summer break, and it's reopened pretty quickly. Normally we come back from a break in January, we walk into reporting season, and then they start to tumble out as all the companies report, all the institutions get through that, and then the brokers and the advisory banks start to bring the companies around, which they've had on ice for a few months.
But it's happened quicker this year.
Oh, look, I think it's just an ongoing trend and flow that you probably had a hiatus because of Corona. Than coronavirus, and that 6 or 7 months companies banked up. And I think also the tech boom that took place out of the coronavirus bear market really encouraged people to accelerate trying to get to market because there was a big appetite for it.
Okay. So when something comes to market and you're in a position where you would look at companies that are listing, what are you looking for? What are you looking for within the stock?
That's a really interesting question because we've grappled with that a lot over the last 3 or 4 months as a lot of these companies have come to market. And a lot of things have changed in recent times, say, compared to, especially pre-GFC, but even 5 years ago. The pricing is obviously something that you're looking for. And the reason for that is because you haven't got a track record to run off on the company. They've been private and they're coming to a public market. So you haven't got that track record where you can rely on the numbers and the management. So you would like some kind of discount to encourage you to get in. So how does that discount work? Normally on comparisons with like companies elsewhere, you'll price it off that and give it a discount because it's coming to the market and you haven't seen it before. But that has evaporated over recent times. The good old 10% discount for an IPO seems to be few and far between. Beyond that, what we look for is obviously the normal things, in small company land anyway. We look at how good the management is, how much growth the company can achieve, what industry it's in, what their balance sheet looks like, what their philosophy is. Nothing different. It's just that you've got to be a little bit more skeptical because you haven't got the security of watching them as a listed company and all the disclosure that comes with that.
It must be a lot harder, though, to get a lot of that information. I know they put a prospectus out, but that's just one document.
Yeah, it is a lot harder. Occasionally you get companies that you just know are in a sweet spot and it will go very well. But for the most part, it is a much higher risk game. There's a lot of institutional investors who just say, well, I don't look at IPOs because I just haven't got that clarity and I haven't got that track record and therefore I won't go near it. I think there's opportunity there still, but it's not like it used to be. The pricing has been marginalised to a large degree. And a lot of that is to do with these days, a lot of the institutions start investing in companies well before the IPO.
Right. Okay. It's an interesting concept because you would imagine that the owners of the company want to maximise the price they get when listing because many of them take money off the table via listing, but you need to attract institutional investors. When something like Airtasker comes and jumps 170%, is that about the wrong price or is that about irrational investors?
Look, I think Airtasker is interesting in the fact that what it did price-wise, because it's the opposite to what I was saying. This one actually gave the people who participated in the IPO an incredible return over a few days, and that was terrific. But Airtasker, I think, in itself, incredibly volatile, up a couple of days. I looked at it closely. The people behind it have done a good job to get to where they are, but it has got some comparisons that you can look at. We've had Freelancer on the boards in Australia for a long time. Now, it's probably an improved version of Freelancer, but it's fundamentally doing the same thing. It's people who have got tasks to do and they're looking for people in the more general market who might be able to perform those tasks and putting them together. It sounds like a great idea. And the other one is High Pages, which concentrates on the trade side of the equation, where you've got stuff to do at home and you need someone with specific skills to come, whether it be a plumber or a builder or whatever. So there are comparisons. And Airtasker, I must say, looked really expensive, incredibly expensive. And it was a real eye-opener where when you did look at their numbers, it showed one of the big problems with online businesses. And one of those is, can it survive? Can it grow without actually marketing at a high level? And Airtasker, a few years back, had a lot of money to spend, and it grew its revenue at a rapid pace. But the problem was its losses just got bigger. And they realised that they needed to wind back on their marketing spend. And when they did that, their growth slowed dramatically. And I think with these job platforms that exist, you've got to be really careful, because freelance has been listed for a number of years and it's gone nowhere. I can't believe it's still got a market cap of 250 million. And when you look at Airtasker, it came on at a revenue multiple that was comparable to other companies that have done an incredible job over a number of years, and then raced to 16, 17, 18, 19 times revenue. And to be honest, I can't see Airtasker making money in the next 10 years. It just doesn't seem to be a model that works that well. Why did it get so fired up? I think you're 100% right. It was a little bit of our own Reddit, where the online brigade, especially younger people who have used Airtasker, and it's a great service. I've used it myself. It's terrific. It just doesn't make money, unfortunately. The ticket on each job is so small, it just doesn't seem to get traction. But the young brigade in particular, good brand, everyone knows it. They've all used it. They probably used it for school for people to do assignments for them when they were younger, and they've used it and they think it's great. And it got a lot of support online, but the fundamentals of the business are terrible. It's not like a platform like realestate.com or car sales, where they're massive markets with reasonably big ticket items, where they make a lot out of each transaction and they can get enormous scale. These smaller transactional businesses, they seem to struggle big time.
Stay with me, Matthew. We'll be back in a moment. My guest today is Matthew Kidman, Principal of Centennial Asset Management. These smaller businesses, and Airtasker being the great example, but the smaller listed businesses, they are higher risk. You've told us that. They do tend to be more volatile, or is it that they're illiquid so they don't have people trading? Kind of how's that all work?
Yeah, no, that's a really interesting question, Sean, because the small ordinaries, which covers the X100 companies, so they're not all small companies, but it includes a lot of small companies, actually doesn't perform as well as the 200 or the bigger market. It does on certain years, but it doesn't perform as well, and it's probably not as any different in volatility. Now, but that covers up a lot of things. Small companies can definitely perform better, and it makes a lot of sense, because a small company by nature can grow into a big company. It can grow a lot quicker. The idea that CBA or one of the banks or insurance company or Telstra can grow at the same rate as a small company, and the obvious one that we've seen over the last 2 years that's captured the market's imagination is Afterpay. It just can't do it. So those companies will rocket, individual companies, but the whole index doesn't move because there's so many of them, doesn't move that much. So small companies have the ability to grow. They've also got fragile business models. So CBA can have a money laundering scandal that costs hundreds and hundreds of millions of dollars, and they just keep going. A small company, something goes wrong, they can disappear overnight. They're not too big to fail. In fact, they're set up to fail if something goes wrong. So you've got to be very careful. They're not too big to go broke. Liquidity is another issue. If something goes wrong, the liquidity is just not there, and it can adjust very quickly, 30, 40, 50%. The price discovery is rapid. So the individual stocks are definitely more volatile. It's not an area for the faint-hearted. You've got to be prepared to take losses as well as the gains we saw in Airtasker.
With these smaller stocks, we talk about the ASX 200 all the time on fear and greed. Last week or the week before, 5 stocks fell out, 6 fell out actually, and others came back in. How important is it to be part of that ASX 200? Is it because of index funds? Does it matter that much?
Yeah, I think in the long run, it's all fine. But generally, if you enter the 200, it's not such a great thing, because you're passing the bat to a different group of investors. not only are companies sorted into their size and which index, so are investors. So you'll have a different group of investors who concentrate in the top 200, top 100, top 50 to those concentrated in the X200. And so a company that is one of the big companies in the small company area enters the 200, it was meaningful to all those small cap investors and all of a sudden becomes the number 200th company in the ASX 200, and it can be ignored to a degree. So there is a transition issue about going from one to the other. But I think in the long run, if you run your business and you're part of the 200, that's fine. You'll get another group of shareholders. But there is a transition issue that makes it very difficult as you go up. I think if you enter the 300 and you haven't been in any index, that is a bonus, because then all of a sudden everyone has to have a look and maybe include you in their index. But the 200 and the 100 is a different story.
Are there any stocks out there at the moment that are wandering around that you think, I mean, this isn't a financial advice and we're not recommending anything here, but even sectors that you just think are interesting over the next little bit?
What, in the small area?
Yeah, in the small caps.
Yeah, I think there's a lot of interesting areas. I think technology is interesting. You haven't got the luxury of a year ago or coming out of the coronavirus where everything was cheap and you could buy anything. But there's definitely companies that are still got good niches that are global in their outlook. And Australians love a business that has a niche where they operate and they're one of the big players and they can go global. We've seen it in something like Cochlear or ResMed in the past. I would put into that category a company, its code is CSX, and it provides masks to people around the world, but not masks that you and I wear, but masks in hospitals, masks in industrial facilities and whatnot. So they're high-end masks that cost quite a bit, and they provide data about who's wearing them and at the high end, and they're attacking 3M, the big American company. Now, that kind of stuff is a great opportunity. There's others in the tech space. I think also, like in the environmental space, there's a little company I saw this week called EnviroSuite that provides noise pollution for airports globally. I think that's great. But even on the domestic front, there's a whole bunch of terrific opportunities where companies are doing well, especially in the recovery, whether it be in the car market, whether it be in retail, whether it be in building materials. There's opportunities everywhere. And companies do grow well. You just got to be careful at that small end. If something goes wrong, you've got to act pretty quickly because they can be brought down at a rapid rate.
Matthew, thanks for talking to Fear and Greed.
Thanks, Sean.
That was Matthew Kidman, Principal of Centennial Asset Management.